All right, welcome, ladies and gentlemen. Thank you for joining us for part one of our transfer pricing webinar series. This is a topic that many people have been asking for. Several of our clients, several of our prospects have been asking us to present about transfer pricing. And so today, we're happy to bring all the experts into one room to help us discuss and understand the different aspects around transfer pricing. And at that, we're going to discuss all the countries in the region. We'll have someone talking about Kenya. We'll have the specifics in Uganda, the specifics in Tanzania, Rwanda, Ethiopia, and South Sudan. And so our only prayer is that you learn as much as you can from this session. Ask all the questions that you can. It's not very often that you have all the experts in one room and you can have all these questions answered without expecting an invoice, by the way. So ask all the questions while the webinar is going on. We will have them answered. And at the end, we will emphasize anything that needs extra emphasis. So that said, Kenya has been in the news quite a bit of late. So it's only fair for us to start with Kenya. And the gentleman starting us off is a gentleman who's been in the tax practice for quite a while. He's advised several clients around the region on matters regarding transfer pricing. He's a senior manager in we'll actually start with the director. He is a director in the tax practice of our office in Kenya. So ladies and gentlemen, join me in welcoming Steve Okoth. Steve, you're welcome to start us off.
Thanks a lot, Moses. Thanks everyone who is attending. It's really good to have you in, our clients and our business associates joining us in this the first part of the series on transfer pricing. We'll be having a series of training to support our clients and the people we work with so that they comply with transfer pricing. Obviously, there have been many changes in Kenya recently, and in the last 2 years, there have been changes in the other countries as well. There are brand new transfer pricing regime in Rwanda and Ethiopia, and it's quite interesting for us. But of course, this is a challenge for many multinational companies and even companies which are purely resident or in the region, but are doing business with their related parties which are operating either domestically or for other countries, or in the case of Kenya, operating in a preferential tax regime. So this will be the first part. Of course, it's quite important to begin by indicating the objectives of the webinar. The key objective is to support you to understand really highlight understanding of transfer pricing and its concepts. Most of the people who are attending this webinar already understand transfer pricing and most of the concepts. Of course, we'll be drilling down to the areas that give businesses problems or that give multinationals sleepless nights in terms of the amount of risk that they're sitting on at any particular time, or the assurance that their compliance is on point. So that is a key thing. Most of you, of course, understand why transfer pricing is critical. Many companies have faced transfer pricing audits or have had to somehow manage transfer pricing disputes, and that can be a little bit of an issue for many companies, especially those who are fresh in transfer pricing audits. Of course, the regime, the tax administrations in the region, Kenya Revenue Authority, Uganda Revenue Authority, Rwanda Revenue Authority, Tanzania Revenue Authority, these revenue administrations are now also ramping up the scale of transfer pricing audits and inquiries. And this is something that now everyone has to confront and prepare for. The other issues that we are going to highlight is really just the framework the regulations, the laws that you have to comply with in each of the countries, and this will be highlighted by our teams. I'm joined by our experts from the region. For Kenya, myself and Zioka will be undertaking. So let's begin by transfer pricing, and in brief, of course, we'll share this presentation with everyone who is attending. So you will be able to go into detail. But in brief, just for you to understand, because if this understanding does not come through, in our experience, there have been problems. Transfer pricing requirement is simply that when you are undertaking business with a related entity, especially a related entity for the purposes of Kenya, a related entity that is not resident in Kenya, or that is resident in Kenya, but is operating in a preferential tax regime, then you need to ensure that the pricing of the transactions between you and them, the pricing of services that you offer them or that they offer you, the pricing of goods that you purchase from them or sell to them, or the pricing of loans in terms of interest rates and guarantees. These, including as well as intangibles that are shared or enjoyed, the pricing of these transactions with related entities or with entities in preferential tax regimes needs to be at arm's length. The arm's length principle is very simple. It means it is priced as if that relationship was not existing between two entities, or that preferential position in terms of tax treatment in law was not existing. Moses, move on. So in terms of highlighting, just to pick a few, and of course, a number of you have gone online and you watch the news in Kenya, you see the transfer pricing rigor and the disputes that are going to the High Court, as well as the disputes that have gone to the Tax Appeals Tribunal and how they have been ruled. Some have been lost by KRA, others have been won massively by KRA. So in Kenya, the first transfer pricing case was Unilever. This happened even before the transfer pricing rules were promulgated under the Income Tax Act. This was a major case, and it probably was the trigger for the promulgation of the transfer pricing rules. And the precedent on that was actually to exalt the OECD guidelines. Unilever had prepared their transfer pricing arrangements in line with the OECD guidelines, and OECD guidelines were taken at that time by the High Court to be really applicable in Kenya in the absence of the rules, or even in the event that the transfer pricing rules are present in Kenya, if they are not sufficiently explanatory, if they are not very explicit and clear, then a reliance will still be made to the OECD guidelines. Remember, the transfer pricing rules, which came in 2006, were just an elaboration of an already existing requirement under the Income Tax Act, which we inherited from the British, that transactions between related parties needs to be priced at arm's length. So the rules were an elaboration of an already existing law. It did not bring the arm's length principle into the country. It was just to expound on the application of that principle. And the High Court then went on to stress that the OECD guidelines, where there is no elaboration in detail, can be applicable in Kenya. Several other cases have gone to the High Court and the tribunal where the OECD guidelines have been pronounced to be judicially noticeable. So in Kenya, I'll go through the brief of the legal regime and show what is really applicable in the country. There have also been a number of cases, the Shaka Ruturi case that you've seen that we put for you in the presentation that for you to probably peruse, was actually a stressing of a critical principle in chapter 2 of the OECD guidelines. So these are basically the OECD guidelines. So you can say that in Kenya, the legal regime actually, or OECD guidelines, is at the core of interpretation of the arm's length principle and at the core of applying transfer pricing. So basically, as you are seeing in the screen, these are the chapters in that guideline. This is quite important. Many people do not pay attention to the rules. Many multinationals fail to pay attention to the rules. This failure to pay attention to the rules, you find that the transfer pricing cases that are being lost by multinationals at the tribunal, at the High Court, you find that the TP documents are prepared very thick and very beautiful, but the actual analysis and treatment of transactions, the actual selection of the methods has not adhered to the orthodoxy which is outlined in the transfer pricing guideline. This is a big problem. This is a big problem because it should be remembered very clearly that while audit firms like ourselves should have guidelines on how transfer pricing documentation should be prepared, we even have templates on if you are talking about this industry, this is a template. If you are talking about this sector, this is a template. We have very elaborate template prepared at very high level or globally with contribution from experts across the world. But these are just internal documents prepared by professionals to aid their work. If a transaction is not treated according to the rules, the tribunal and the courts will only adhere to the rules, and you find that you lose. So this is the reason why we began by outlining some of the requirements that have been outlined in the guidelines, that the guidelines provide what and how to apply the arm's length principle, the transfer pricing methods and how to select them. The Shaka Ruturi case was a focus on adherence to the principles which are outlined in chapter 2 on how to select a method, which method is preferable under what circumstances. So all this, how to prepare documentation, cost contribution arrangements, how to apply the methods, everything is outlined in the guidelines. And so far, our TP rules are not comprehensive enough to fulfill the threshold that was stated in the Unilever case. So what we still have as the comprehensive guideline is the OECD guidelines. So Moses, just move on. So this is really the framework. The rules of the land that have to be complied with across the region. So the arm's length principle has primarily been brought and stated in the various income tax acts, the legislations that we have in the region, Uganda, Kenya, Tanzania, Ethiopia, and Rwanda. There are very explicit requirements, very clear requirements on the application and for the application of the arm's length principle. Of course, then each of the countries have their own specific transfer pricing rules that have been published either by ministers or cabinet secretaries in the case of Kenya. And the OECD guidelines is applicable in all these countries. In the event of a dispute, the OECD guidelines will carry the day because they are the comprehensive guidelines that we still have. So this is what controlled transactions I've mentioned on this one. Moses, you can just move in, or everyone understands that controlled transactions between parties which are related either through common shareholding, common ownership, or common management at the board level, or shared directors, shared between two entities, or entities that are related because they are owned by members of a family who are either family members either by way of blood or by marriage, consanguinity and affinity. Of course, the scope of what is captured under TP in Kenya has been expanded. The scope of what is a related party has been expanded. A transaction with a major customer that is commanding over 90%, major data, major transactions with people who have significant control in the business have now also been captured in Kenya. So there are specific provisions, of course, which we shared also earlier on with our clients and also our business associates earlier on. Moses, just move on. So this is the reason, or you understand what the arm's length pricing is, and transfer pricing used to be the holy grail of transfer price of tax planning. Companies used to just set up entities in international financial centers, which are also called by other name as tax havens, and then they ensure that they are pulling a lot of profits into those low or no tax jurisdictions, and they just there's really no arm's length adherence, and so they make very little or to no profits in the countries where economic activity is being undertaken, and they pull it off to places where there is no payment of tax. The other origin of this whole concept was in Europe, where different countries were fighting for their share of profits between groups that operate in several countries. So you find Germany wanting their fair share of taxes from a multinational entity that operates in the entirety of Europe. France wants their shares, or UK wants their share of a fair share of the profit. So this is what led to creation of elaborate rules. Just move on, Moses. Moses, move on. So in terms of determining the arm's length price of a transaction, it's very simple. To understand the concept takes 1 minute, but to accept the concept has been a struggle for many people. There is a reluctance to accept the principle. The principle is basically that if that transaction was undertaken in the arm's length scenario, the way it will have been priced, or price the one which you are undertaking in the control scenario, in the related scenario. That is really the summary of it. If this is accepted, then a lot of risk is mitigated. There are a number of methods, of transfer pricing methods that are there. Comparable and controlled price. This is where you compare like for like. If like for like is available, you pick it and you apply it. Where cap is applicable, it is mandated that it be the preferred method. This can be for services, for loans, or even for goods, mostly for goods. There are many times when it is not applicable, and and in the circumstance that it is applicable, it must be applied. This is a Shaka-Roturi situation that we are looking at. Then there is the cost plus method and the resale price method. These are the initial priority method. Transactional net margin method is the one which is applicable in almost 70% of TP arrangements that we have in the market. Then profit split applies, not in all cases, but in cases where two parties, two entities in a commercial scenario, in a business scenario, are making valuable and special contributions to value creation, to creation of the product or the service that eventually is then sold to the market or together. So that kind of determining what is the value contributed by this, or what is the value contributed by this other party, and how do we divide the basic profits to be earned by each, and then how do we apportion and split the residual profit or loss that is then remaining. That also is quite important, especially for people in the horticulture sector who are also operating EPZs or operating SEZs. So the processing entity is in a preferential tax regime, and the growing or the primary mining is being undertaken by normal companies under the normal tax regime. So that is always the preferred method under those scenarios. Move on, Moses. So the journey for review of the international tax architecture began sometimes in the discussion was already ongoing, but after the global economic recession that hit the United States and then the world, or after the 2008, or many countries found themselves in serious cash problems, and it was discovered that multinationals and financial institutions, especially international ones in nature, had structured the arrangement such that they were not paying tax and letting the small businesses to be the ones who are shouldering the burden. So this process was sponsored by G20, G8, then G20. Barack Obama was a key mover of this movement to end base erosion and profit shifting, basically eroding the tax base and shifting profits to tax havens or international financial centers. This was a long journey that people undertook, the action points to aimed at combating this and amending the OECD guidelines, the transfer pricing guidelines being embedded to ensure that such practices, practices that were aggressive or were curbed. Then pillar one, this is to ensure that multinationals that are making sales into a particular country without presence also pay their fair share of income, which is derived from those entities. And then we'll then move on to the global minimum tax, which is going to come at some point. This is still controversial, but you can see the moves being made by Rwanda. You can see the moves being made by Kenya in terms of treating certain jurisdictions, certain countries as preferential tax regimes simply because they have low tax rates. Then they are already upgraded OECD transfer pricing guidelines. Moses, move on to the. So these were the tasks that were being undertaken by OECD under the direction of G20, or how to tax the digital economy, hybrid mismatch arrangements. These are sophisticated tax planning structures that give a lot of advantage in the planning of effective tax rates, how to treat controlled foreign companies, financial payments, harmful tax practices, treaty abuse and treaty shopping, attribution of income to permanent establishment. These are the branches of multinational entities that are operating in countries of operation or of projects, or treatment of intangibles, how to handle risks and capital, and how to price the same. Transfer pricing for high risk transactions, data and methodologies, disclosure of aggressive tax planning structures, transfer pricing documentation, and review of the existing process, dispute resolution mechanism. So multilateral instruments. It's a big package. So many documents were presented, but ultimately these have been reduced into working documents and an updated OECD transfer pricing guidelines. These, based on the precedent in Kenya, are all binding to Kenyan companies because they're the detailed guidelines, and our judicial process has already embraced and adopted the OECD guidelines as a key provider of guidance in terms of interpreting international tax and transfer pricing. Moses. Okay, so I will now invite Nzioka to continue with the specific guidelines for Kenya. Nzioka is a senior tax manager with us, and he has vast experience in transfer pricing. He's worked in PKF, he's worked in Viva Africa before. Is a specialist in transfer pricing and international tax in general. He has worked with many companies in developing and updating transfer pricing documentation. He's built working tools to support with the updated requirements for local files and master files, and we'll be supporting a lot of our clients. So I would like to invite him to continue with the next phase of the presentation.
Thank you, Steve, for that wonderful introduction on transfer pricing and the general provisions under the OECD guidelines and new developments such as BEPS that have greatly influenced not just Kenya, but the whole of the entire East Africa in setting up their TP structures and their TP laws. So I'll pick it up from where Steve stopped and now focus on Kenya. As we move on, other presenters will also focus on the respective countries, specifically Uganda, Tanzania, Rwanda, Ethiopia, and South Sudan. So in 2022, the Finance Act was enacted, and this Finance Act took effect on 1st of July 2022. Bulk of the provisions took effect on 1st of July 2022, with some taking effect 1st of January 2023. However, for transfer pricing related matters, these amendments took effect in 2022 July, 1st of July. Now, in Kenya, we previously did not have very robust transfer pricing rules, basically, and legislation. It was a bit basic, but now the Finance Act of 2022 amended the Income Tax Act to provide for a more elaborate transfer pricing regime. I can dare even call it an overhaul of the transfer pricing regime. And when we look at it, we will start with the new filing requirements. So the Act now has been amended to provide that an entity with transactions with its related party outside Kenya will now be required to file a master file, a local file, and will also undertake country by country reporting. Basically, when you look at the transfer pricing regime in Kenya and also in East Africa, it follows the OECD transfer pricing guidelines and also initiatives such as the BEPS initiative, which stands for Base Erosion and Profit Shifting initiatives, which have also been adopted into Kenya. And this three-tier TP filing approach is basically Action Plan 13 of BEPS. And when we look at it, it also requires for you to have a master file, a local file, and for the jurisdiction to provide for country by country reporting. Now, what is a master file? A master file will be a document that indicates and describes the multinational global operations, the value chain, and the general provisions applied for transfer pricing purposes at the group level. So the master file will not contain the actual benchmarkings for each and every entity, but will basically give an overview of exactly what the group does, what industry it plays in, and other information which we'll be able to look at as we proceed with the presentation. Now, we're also required to file a local file, and the local file, the LF, will have the local information about the taxpayers as well as volumes of the intercompany transactions in the group. This is basically what we have been having in Kenya, where we've been creating a transfer pricing policy, and then for taxpayers or our clients, and it includes it's a very detailed document reflecting each and every related party transaction and having the benchmarking studies undertaken for each and every transaction. So now that will basically now be our local file. Then we have also now, now the third one is a country by country reporting, where multinational entities will now be required to file a country by country return basically allowing us to see what kind of transactions have been undertaken, and also other information about the group that will be required by the commissioner. As I indicated when we started, the TP regime is basically overhauled for right now. And when you look at it, we still don't have, the commissioner has not given us direction as to how the TP return will look like. They've not given an indication. Will it be an online, will it be done in an online manner? Will it be done, how exactly the filing basically will be done? But as we expect with other jurisdictions that have already taken up this sort of practice, we already have an idea of the kind of information and the kind of format that the TP return or country by country reporting will be undertaken. So that's the three-tier approach that is there currently that has been implemented. Moses? So moving ahead, this is basically now the rules that are there. These are the guidelines. These are for filing of the TP returns. And as you can see, the CBC return will be filed not later than 12 months after the last day of the reporting financial, the last day of the reporting financial year of the group. Then an ultimate parent entity or a constituent entity of an M&E group shall file a master file or a local file to the commissioner in such a manner as the commissioner may specify. Again, I will, just for sake of clarity, that I will insist that we still have not seen the manner in which we shall be filing these TP returns. But we will, and also undertaking this country by country reporting, but in time we will know. And once we know, we will definitely inform our clients of the same, such that all our clients can be compliant here in Kenya. Now we'll be required to file the master file and the local file not later than 6 months after the last day of reporting of the financial year of the M&E group. This was a very important development. This is because when previously or before 1st of July 2022, we were not required to file our transfer pricing policies with the commissioner. So you develop it, you'd implement it, you would keep it. And as at the day that the commissioner asks for it, then you would provide it. If you are undergoing an audit, then you would need to support your related party transactions, and you'll be able to support the application of the pricing through your transfer pricing return policy. However, now we are seeing that the commissioner will want for us to file our master file and local files not later than the last day of the last reporting financial year. Now, the implication on you as a taxpayer will be that you will be required now to, at the end of every year, basically, or during the year, to make sure that if there's any new transaction that you're entering into, that TP policy is updated. We used to encourage our clients to do the same. However, you'd find that mostly a client would, most clients would take it as a periodic exercise and look into it maybe 3 years later or 4 years later and request for us to update. But maybe there's a transaction that came up 2 years after we had already done our initial transfer pricing policy. So this is a new development, and it will require taxpayers to be on their toes in terms of updating their TP policies. It will also require us as your auditors and your tax consultants to also be on the lookout, such that we are able to inform you that you need to update the TP policy, and this, so that you're able to fulfill the requirements of the as provided by law. Sorry for that. So my apologies. So this will have to be done 6 months after the last day of the reporting financial year. The laws require that the commissioner maintains confidentiality on all of the TP returns that are filed, and all the master file, local files, country by country reporting. Basically, any data that now will come from any data that will come from the taxpayer, the commissioner will be required to ensure that it is kept confidential. Of course, for these are trade secrets or trade, basically to just make sure that there's sanity with that. Moving forward, we will have any person who does not comply with the new rules provisions will basically be subjected to penalties prescribed under the Tax Procedures Act, and these will be the general penalties. So with the amendments, there were no specific penalties provided for failure to comply with these TP policies, but we've been referred to the transfer pricing, to the Tax Procedures Act, to specifically address the penalties that will be there. However, we do expect that at some point the act will be amended, and there will be specific provisions for failure to comply with these new TP provisions, just as there are for late filing of pay-as-you-earn return or late payments, and etc. So yes, we can move on. Then, as I had indicated earlier, we are looking at the action plan 13 of BEPS being implemented almost in its entirety. And one of the other conditions that is there under the BEPS action plan is covering the CBs, covering the country by country reporting, is that there will be a requirement for multinational entities in Kenya, operating in Kenya, to provide a CBCR notification to the commissioner. Now, this requirement will be for an entity which has whose group has a gross turnover of 95 billion Kenya shillings. That's approximately $790 million US at the current exchange rate. And will be done not later than the last day of the financial reporting of the group. So this notification requirement is effective in the year of income 2022. So basically, what the law is saying is that if any entity had a financial year end for the group post 1st of July 2022, then they should have already undertaken and provided the notification. However, just like the CBC reporting, we do not yet have a prescribed manner and format in which we will undertake that notification. So the commissioner has not yet provided any notification, and we are yet to see the commissioner also come after taxpayers who have not yet sent those CBCR notifications. So yes, that is also another new amendment to the Act.
Nzioka, you're beginning to break. Nzioka? All right, so as Nzioka tries to get the internet right, I'll ask those of you who have any questions to keep writing them in the chat section. The experts will keep answering them as we go along. And again, the very last ones of questions that, or some of those that need emphasis, will be emphasized at the very end. Nzioka, are you back? Okay. Nzioka, if you're speaking, your mic is muted.
Hello?
Perfect.
Yes.
Perfect.
Yes, Moses, I'm back. Sorry for that. I'm back. I can continue?
Yes, please go ahead.
All right. So I'm very sorry for that. We just had a slight incident with the internet and these things happen, but I'm very sorry for any inconvenience caused. So as I was saying, with the country by country reporting, the Act has actually specified the exact information that it may want. And as I had mentioned, each constituent entity will need to be listed and its identity, the jurisdiction of or tax residency, where it is domiciled, and the main business activity carried out by each entity. Then on the group's aggregate, on the group information will
Nzioka, we are losing you again. Nzioka, when you're ready, just let us know. Otherwise, we want to appreciate the over 400 participants that are joining us this afternoon for this webinar on transfer pricing. This is just part one. We're going to have part two, part three, and all the other parts until we have exhausted all that we need to exhaust in transfer pricing. And the key thing for us in this is to simply help you operate smoothly. So ask all the questions you have within these webinars. And if you have any challenges thereafter, we'll still remain available for consultation. Nzioka, just let me know when you feel stable and you can start again.
Yes, I'm stable now. So I believe we can continue. I'm hoping I won't have any other network issues.
Possibly you can just stop sharing the video and then the sound will get better.
All right.
All right, you can go ahead.
Yes. So yes, as I was saying, with the country by country reporting, there's specific information that will be required, as you can see. Importantly, like I'd already mentioned about the identity of each constituent entity, and also now we'll be required to disclose the revenue for the group, the profit or losses before tax, income taxes paid, income tax accrued, the capital, accumulated earnings, number of employees, tangible assets, and cash equivalents. Also, the law has provided the commissioner with a bit of leeway to be able to request for any further information or require any further declaration through the CBC reporting return, CBCR return. So that is what will be required. And moving forward, I believe now we'll be able to discuss more. Moses? Next slide. So we will be able to look at who will be required to file this CBCR return. As you can see, the non-residents will get parent, and if the non-residents are has not filed, if the jurisdiction requires filing of the CBCR, if a competent authority of the jurisdiction of the surrogate parent entity in Kenya do not have an agreement or exchange of information, the competent authority of the jurisdiction of the surrogate parent entity has informed Kenya of a systemic failure of filing of country by country return, and the non-resident ultimate parent entity has informed its competent authority, that is the revenue authority on that other side, the surrogate parent entity is designated surrogate entity of the group. It is important to now get to find out what do we actually mean when we say surrogate entity. So the ultimate parent entity means basically an entity that is a such kind of entities are like listed entities where Kenya. Then we have a constituent entity, and there is a definition there, and I'm sure we will be sharing these slides and you'll be able to go through. But basically it means a separate business unit of the multinational entity, a PE of any separate business or the multinational group, or any such business entity, or rather any such entity that is actually under required for you to report under the consolidated financial statements solely based on size or on materiality grounds. So basically just an entity within the group. And a surrogate entity. Moses, the next slide. A surrogate parent entity means one constituent entity of the multinational group appointed by such a group to file the CBC report in that constituent entity's jurisdiction. So, or on behalf of the group, basically the entity that is assigned to file. Now, we'll go forward and look at what will be required to be contained in the master file. We'll also look at what will be required to be contained in the local file. And we'll lastly look at the preferential tax regime, which is a new provision that, or rather a new provision. The provision has been amended to bring into on board other entities, which may actually not be related parties. And this is a very interesting development. So we'll first start with the master file. So as you can see on your screen, the master file basically will need to give the group overview. It will need to give a description of the supply chain. It will need to disclose key products and services provided by the group. It will need to outline the research and development policy of the group. It will need to contain the group assets and intercompany agreement on the assets. It will need to disclose anything on intangible assets. It will need also to disclose any tax rulings made in relation to the group in other jurisdictions. And it will also need to disclose any value creation by each constituent entity. Now, of course, the law provides the commissioner with room to be able to require any more information or add any further declarations to be put in the master file. And so the commissioner will have that power. And rightfully so, there might be situations where he may need to request for certain documentation or information to be reflected or contained in the master file. Then now we will look at the local file, what information has been specifically provided under the law to be contained in the local file. And we will require to have detailed activities and all information in relation to the resident constituent entity in Kenya. basically, if you look at the files that we've been creating, the transfer pricing policies that we've been creating, they're basically what the local file is being discussed, having the detailed activities of all information, having the international transaction and any amounts paid or received by the resident's constituent entity, the management structure of the constituent entity, and the residence entity business strategy, such as the structuring, description of the controls, transaction, description of the business, and then basically the industry that it is in, and the competition, and how it manages competition and who it considers as its competition. Then, of course, any other information that the commissioner may require. So we will be requiring to go deeper with the local file when preparing one. Then now we will look at what is the preferential tax regime. Now, we have kept on talking about transfer pricing is actually the study of the transactions between an entity in its jurisdiction and entities with its related parties outside the jurisdiction. Now, relation has to be demonstrated, and relation basically was provided for. Now, when we are looking at the new provision, we are looking at and maybe I can first go back to the previous. To the previous rules and how provisions that were there. Before this, we were only looking at related parties that were in an SEZ or EPZ. That's a special economic zone or an export processing zone. Now we are actually looking beyond that. And the new laws are saying that now not only will it be within the SEZ or EPZ zones in Kenya, but we're actually looking at even in other jurisdictions, in a foreign jurisdiction. And it's actually now looking at whether or not, and now it's actually saying we don't discriminate if you are related or not. So the preferential tax regime provision will actually apply to an entity that has dealings with an entity in Kenya that is outside Kenya and in a jurisdiction that does not have income or taxes rate higher than actually 20%, does not have a framework for exchange of information, does not allow access to banking information, and lacks transparency in corporate structure, ownership, and beneficial ownership, financing, and regulatory supervision or disclosures. So if an entity that is not related is actually operating in a jurisdiction that the commissioner is saying is a bit suspect in his view, then we will be required to see how to kind of disclose that particular transaction. This is a very interesting development, and we are looking to see how this will be undertaken. And I'm excited to see what kind of case law will we be getting from this kind of from entities that maybe will be assessed by the commissioner for maybe not having disclosed such a transaction. So it is a very interesting provision. Like I said, it has expanded what was considered as a preferential tax regime. Previously, it was only related parties operating in an EPZ or SEZ special economic zone or export processing zone within Kenya. Now it has gone outside of Kenya, and a matter of relation is basically now has been brought into place. And I would like to bring your attention closely to a jurisdiction that does not tax income or taxes it at a rate lower than 20%. And with that, I believe I have come to the final stage of my presentation, and I would like to now invite Pamela Saka. Pamela Saka is a tax manager with BDO Uganda. and has joined, and Pamela joined BDO
You take it
You seem to be breaking.
I'd like to present to you Pamela. Pamela Kaya.
Thank you, Nzioka. Thank you all for joining the call and the webinar. I hope it's fruitful for you all. Okay, so I'll start with a quote from Ronald Reagan. He says, government's view of the economy could be summed up in a few short phrases. He says, if it moves, tax it. If it keeps moving, regulate it. And if it stops moving, subsidize it. So I'll move straight into the transfer pricing guidelines for regulations for Uganda. And we shall talk about the background, compliance requirements, yeah, and you know what URF focuses on. So this should ideally be very good for those that are coming from Uganda. So URF is following the OECD guidelines, and so URF is following the OECD guidelines, and once this change, the URA guidelines change as well. However, in cases of inconsistencies, URA follows the Income Tax Act at that point. Follows the Income Tax Act at that point. The current guidelines that we have were put in place in July 2011 by a practice note of through a statutory instrument of 2011 and a practice note that spells out exactly what is expected to appear in the transfer pricing document. And as you've noticed, as you've all noticed, URA has put in place a team of experts that I think sits at the 7th floor, an international tax unit that looks at international tax and transfer pricing. So this is a very important topic, and like Steve and Zioka have mentioned, it's a global issue and countries are picking up on it, and URA has not been left behind. So maybe before we proceed, it's important to note that in ordinary course of business, URA would not consider a branch as a separate entity. However, for transfer pricing purposes, this is considered a distinct person from the head office and therefore deemed to be an associate entity. So who is required to comply? So the URA expects associated entities, and by associated entities, we're talking about entities that are related, yeah, that have cross-border transactions, and they're saying that for cross-border transactions there is no threshold, and that means that all transactions, cross-border transactions, between associated entities should ideally have a transfer pricing policy in place. And then it goes further to require associated local entities whose related party transactions exceed 500 million to have a policy in place. So for these two, it's important that for all your related party transactions, these are recorded in a transfer pricing policy. So Unlike Kenya, Uganda does not require one to file this document with the URA unless specifically requested by the commissioner. And we are required as taxpayers to have a document, an updated document in place within 6 months after the end of the financial year. So basically the deadlines for filing your final return and the deadlines for having an updated transfer pricing document in place. So Uganda recognizes the 5 methods of transfer pricing. However, there's a bit of, it allows a taxpayer to use any other method that the taxpayer feels would give a better outcome in regards to arm's length. Yes, so but this method that has been chosen by the taxpayer needs to be approved by the URA. So URA also does not require exempt persons to have a transfer pricing policy in place. Yeah, so Moses, next. What are the consequences of non-compliance? We felt it important for you, dear listeners, to understand what the consequences of non-compliance could be. So we are looking at adjustment of your chargeable income. Of course, this would mean payment of more taxes, penalties, and then there's reputational risk. And then there's also halting your business operations because you're undergoing an audit and all such things. So it's important that you get the right people to prepare a policy that can be presented and would not cause issues to the company. Moses? What are the offenses? So the regulations stipulate offenses, yeah, and failure to keep a transfer pricing document is one of them. Also, failure to comply with the arm's length principle is another. So you can see that it is very important. And if you have noticed that URA has become quite aggressive lately, and I'm sure that these are things that are going to be more rampant. So on conviction, the penalty would be 50 million. So we can see how punitive that is. So we shall look at other provisions in the transfer pricing regulations. And we're talking about corresponding adjustment. If an entity, an associated entity in country A has undergone a transfer pricing audit and has had adjustments made to its chargeable income, that adjustment would definitely affect the chargeable income of the associated entity in Uganda. So the commissioner allows for a compensating corresponding adjustment to be made after confirmation and comfort that the corresponding adjustments made actually are in line with the arm's length principle. But this is only for countries where Uganda has a double taxation agreement. And it's basically to avoid double taxation. So Uganda has double taxation agreements with a number of countries, for example, Netherlands and Mauritius. And it's important to note that these are currently being renegotiated by the Ugandan government. Moses? Then there's the other provision of advanced pricing agreements. So these agreements are basically you as a taxpayer going to URA and asking them to determine a price based on the transaction details that you give them. And how does this help you? It gives you certainty. So you know that the URA has given you this price and it is okay. You've gotten into an agreement that for a certain period X, you'll be using a certain price. Yeah. Then it allows more flexibility in transfer pricing methods, because while they are doing this, they try to use the best bits of all methods to get you the best arm's length price. And of course, it reduces annual compliance costs because getting an advisor and all that may be quite expensive. However, we have not seen URA handle any APA, and this could be because it requires extensive review of the transactions, as well as transparency on the side of the taxpayer. So you can see how much work would be involved. So, and they're also very highly complex transactions. So I think this is why URA has not entered or handled any APA. So for you to get into an APA, you're required to, of course, request, then give a proper description of the transactions, and then, of course, identify the countries you wish to participate in the APA. And this could be countries where your associated entities are. Of course, any other information requested by the commissioner would be relevant for the authority to get into a proper agreement with the taxpayer. Moses? Then there's the aspect of customs valuation. So we see that associated entities will probably charge a lower price, and this is aimed at lower customs duties, or a higher price aiming at deductions in the ITA. However, we have also seen the authority put aside the transaction value method and issue top-ups in cases where they feel that the prices are not at arm's length. Yeah, but it's important to note that in cases where the price has been adjusted, say upwards, only the price that was paid for a particular item should be recognized in income tax and not the revised amount. And then there's also cases where adjustments, after a transfer pricing audit, adjustments are made to say the price, and this is reduced, yeah, for purposes of getting to the arm's length price. But at the point of importation, taxes were paid on the higher price. So in such cases, a taxpayer is allowed to get a credit note from the associated entity and ask for a refund from customs. However, this has to be done within a period of 12 months from the time these goods got into the country. What's next? What is URA focusing on? URA is focusing on services, an entity that has probably a shared CFO, shared CEO services. These are sub areas that URA is focusing on currently. Then we're focusing on intangibles, things like trademarks. How are you benefiting from the trademark? Is it really, are you allocating to it the right costs? Yeah. Then of course there's the procurement function that deals in goods, purchase of goods, and the procurement function is a key area for URA. And also, I thought it necessary to note that URA is currently probably not focusing so much on interest payments, because this risk has already been mitigated by Section 25 of the Income Tax Act, where effective July 2018, URA introduced the interest capping rules. How do these work? Members in a group are allowed to deduct up to 30% of their earnings before interest, tax, depreciation, and amortization. So anything over and above that is disallowed and carried on to the following for 3 years. And after that, you forfeit it in case the business does not become profitable. However, there's an exception to the financial services and insurance companies. And that means that for these sectors, this is also something that the URA would focus on for these two sectors. Moses, next. What are they looking for? Basically, they're looking for multinationals in a persistent loss position. Yeah. The assumption is that a multinational shouldn't be in a loss position for a long time. But if it's persistently in a loss position, then this raises red flags for the URA. Companies with cross-border transactions, especially those moving money low tax jurisdictions that you usually call tax havens. Those also create triggers for URA. Then there's industry surveys. If other players doing same business that you are doing are not charging for a particular item, can you hear me now? Sorry about that. So methods used to charge for services, that is the turnover, is also an issue here, because for you to use the percentage of turnover, that function needs to be connected to the sales. Like it should be seen to contribute to the sales generated during the period. And let's move on, Moses. So what challenges are our clients facing in putting in place transfer pricing documents? First, we have a few public databases available, and getting access to this is quite expensive, which makes the benchmarking exercise very, very costly. And then there's also a few only independent actors in a particular industry. Yeah, so getting comparatives becomes a problem. And then we find that certain companies engage in transactions, other companies may not engage in, say because of the costs involved and that usually also causes a challenge when it comes to getting comparables and getting transfer pricing documents done. I hope I have been quite clear, and we have tried to throw more light on the transfer pricing guidelines in Uganda. Thank you very much. I'll hand over to Moses to introduce the next speaker.
Right, thank you, Pamela. And I'm glad I came in at a point where gender balance has been struck. It's always impressive to come in after a lady has made her presentation. But as we said earlier, we are giving you bits and pieces of every country. We have had Kenya, we've had Uganda, and now we are going to Tanzania. And the gentleman speaking to us from Tanzania has been in the practice for quite a while. He's practiced for more than 30 years, and he's a partner in our office in Tanzania. Ladies and gentlemen, join me welcome Yusuf as he talks us through the specifics of Tanzania. Yusuf, you're welcome.
Thank you, Moses. Can you hear me?
Yes, very clearly.
Okay, thanks. My proper name is actually Yusuf Chanyika. There's a typo in my name, but it's not a big issue. We can continue. Most of this has been covered, so you can move on to the slide where we are shown when we started the TP regulations. There. In Tanzania, like any other countries in the world, we follow OECD framework. And in Tanzania, the TP regulations came into force, the new regulations came into force in 2018. But this is a replacement of the previous regulation in that was there in 2014. The new regulations came by way of a government notice in April 2018, but they were released in November of the same year. The Tanzania regulations, as it has been mentioned, like in other countries, they follow the OECD regulations and UN practical manual development for the development countries. But For our regulations, where there is any inconsistency, our regulations will prevail. Can you move over? Because the rest has been covered. Moses? Again, move over. Next slide, Moses. Yes. Now I wanted to cover, no, the one before this one. Before documentation. These are the aspects of the TP regulation in Tanzania that, go back please. Moses. Next slide. Next again. I think my internet connection is not good. Can you hear me?
Yes, yes, we can hear you very clearly.
Yes, you're moving back with the slides. Just move forward. Yes,
Is it,
I wanted to.
is it this one, transfer pricing regulations?
No, the one before this.
That's
I want to say
again,
something.
transfer pricing regulations.
Yes, there. Stop there. Our Tanzania regulations are actually centered on the following aspects. It talks about documentation, intergroup services, transfer pricing methods, branch and the headquartered person, commodity transactions, comparability analysis, intangible property between associated persons, and advanced pricing arrangement. You will find out that most of this are covered in the OECD chapters, chapter 1 up to 10, that has been highlighted by Steve before. So next slide is on documentation. Move over. The regulations actually stipulates the kind of documentations that are required therein. Actually, there's a lot, but the main requirement is that you are required to file a transfer pricing policy or a transfer pricing documentation if your transactions with the related parties are more than 10 billion T shillings. 10 billion T shillings is approximately 4.3 million USD. If your transactions are more than this, you are actually required to file your TP documentation with your annual tax return. The annual tax returns comes 6 months after the end of the financial period. So it is a must if you have reached this threshold. But in case you have related part transactions that do not meet this threshold, you are still required to prepare and keep ready these TP documentations so that if TRA will come to you asking for the documents, you have to provide them within 30 days. Next. There are some more additional details that are required in the documentation. In the TP policy, you have to show computational workings carried out in determining the transfer prices. You have to show the actual workings. How did you arrive at the price you are charging to a related party? Also, you have to show the financial performance and financial indicators for at least 3 years. It's like you're showing your financial statements and the indicators. In case you have tested parties that you have selected, and these tested parties outside the country, you have to ensure that you have enough information related to the tested parties. Otherwise, you will be in trouble. You have to describe the control transactions, including their volumes, and the values involved. You have to show group and operation structures. You have to show roles and shares of the shareholders percentage. This list is not exhaustive. We have just shown a few examples, but the regulations have all the details. But in case the commissioner feels that you are required to provide some more information, you are required to provide some more documents, he is empowered to ask for this documentation from you by way of notice, and he'll give you that notice in writing. Next. Intragroup services. If you are engaged in intergroup services, you have to demonstrate that the services have actually been rendered. The services have actually conferred economic benefit or commercial value to the business that has improved its commercial position. It means you have to be so clear on these services to show that they have actually conferred an economic benefits and they have actually added value to your company. And you have to make sure that the charge for intergroup services is justifiable and at arm's length. In case there's a company, say a headquarter, that provides services to various associates, and it is not very clear how they can allocate these charges to the associates, there must be some allocation basis that makes sense. For instance, if the HQ provides computer services, it is to allocate the services by using the number of computers in the associates. If the services is fleet management, one can use the number of cars to allocate the services. If it is HR services, you can use the number of employees to allocate these services. Next. When it comes to intergroup financing, the emphasis is actually to have arm's length interest rate for all the related companies, because these related persons involved in intergroup financing, either directly or indirectly, with or without consideration, are required to determine the arm's length rate for this service, financial service. In case there is a loan, for instance, and the loan is interest-free, TRA will come back to you to say that we are imposing an interest rate to the loan between the related parties. And if this happens, a deemed interest will also attract withholding tax on interest. Next. As with other jurisdictions, the transfer pricing methods are the same. So in Tanzania, we also use the TP methods that have been shown before, but the emphasis is for the three traditional methods. And in case you think that the three traditional methods will not describe the transaction, you can go to the profit split method or any other method that is stipulated in the OECD guidelines. But you have to make sure that whatever method you have used gives the same results as any other method is stipulated in the regulations. Next. So I wouldn't go to explain the methods I've said. They're actually the same methods. The traditional transaction method are comparable and contract price COP method, the resale price method, and the cost plus method. Next. And the transactional profit methods are like the transaction net margin method and the profit split method. Next. Though the regulation has suggested a variety of methods, it says that a person should first apply the traditional transaction method before considering the transactional profit method. On the other hand, regulation stipulates that one should apply the most appropriate method having regard to the nature of the transaction and the functions performed by the related parties. Furthermore, the regulation requires that when the controlled transaction involves the sale of an IP, that is intangible property, the arm's length price should be determined by applying the CUP method. Or if the property is highly valuable or unique, the profit split method. As I mentioned earlier, the regulation allows a taxpayer to apply any other method if the taxpayer can establish that the above method cannot be reasonably applied, and that the alternative method gives rise to a result that is consistent with that between independent persons engaged in comparable and controlled transactions. You have to prove that whatever method you have used will give you the same results. Next. The regulation also states that where the most appropriate method requires selection of a tested party, I've said it before, that is outside Tanzania, such a party shall be considered only when a person has provided all the relevant information of the tested party. In other words, it is likely that TRI will reject a tested party if it is a foreign entity and its financial and other information has not been available to the TRA. So all taxpayers should carefully consider the choice of a tested party, taking into account the level of information that they can obtain in the case of a foreign tested party. Next. Branch and headquartered persons. There's more clarity in the recent regulations to say that a branch and it is HQ and it is head office are different persons. So a branch is considered to be a separate person to the HQ. I think this also applies to Uganda, if I'm not mistaken. Next. Commodity transactions. In case you are dealing with controlled commodity transactions, this should be priced using the CUP method. The quoted spot rates can be used as a benchmark to determine the arm's length price for the controlled commodity transactions. And the regulation says that these quoted spot prices can be obtained from a domestic or international commodity exchange market. Next. Comparability analysis. It is emphasized that the use of domestic comparable data is very important, and the external data may be used only when there is no domestic data available. It means you have to use the domestic data first, and in case it is not available, then you can do your comparability using external data. And it says that if a comparability analysis is applied in more than 4 comparable data points, the arm's length shall be the data point between 35 percentile and 60 percentile. And in case of 4 or less comparable data points, the arm's length results should be taken as the average. The median point of the arm's length range would be used to make adjustments during the audit. It means during the audit, if there's any adjustment, the median point should be used to make that adjustment. Next. In case of intangible properties, one must take into account the contractual arrangements in respect of the development, improvement, maintenance, protection, and the exploitation of the intangible property. And the regulations say that the owner of a locally developed IP that is transferred outside Tanzania should be compensated appropriately at the time of the transfer. Importantly, the regulation provides that such an IP cannot attract a royalty when licensed back for use in Tanzania. That is, the royalty fees shall not be eligible for tax deduction. If you have been charged these royalty fees and it was debited in your P&L, when makes the tax computations, it will not be allowable for tax purposes. It is an inallowable deduction. Next slide. The regulation also talks of APAs. Actually, this has been defined by Pamela, so I'll just dwell on the specifics for Tanzania. In Tanzania, the maximum period for an APA is 5 years. So it means you cannot have an advanced pricing arrangement with TRA that is more than 5 years. You can do 2 years, 3 years, maximum is 5 years. And you're also required to submit an annual report if you have taken that route. The regulation also talks of circumstance that can cause the APA to be cancelled. One of them is material compliance failure in relation to the terms of agreement, or if there is a breach of critical assumptions, if there is a material change in the tax law relevant to the agreement, or if there is misrepresentations, mistakes, or omission in the APA. Basically, the APA does not intend to determine the taxable profits or the revenue to be taxed, but it shows the criteria for the assessment. That is the most appropriate transfer method to be used. Next. Penalties. In case you have not complied to the regulations, the regulation stipulates a number of enforcements. A penalty for any adjustment made during an audit is 100% of that adjustment rather than 100% of the underpaid tax. So the whole amount should be adjusted and not like a percentage of the tax that has been underpaid. The regulation links the penalty to the absolute adjustments rather than to the tax applied to the adjustments. So if you fail to maintain TP documents, you are committing an offense. And under these regulations, you could serve a jail sentence of up to 6 months, or you can be fined a fine not less than shillings 50 million. And in arriving at these fines, currently there is a current point system, and the penalty for failure to comply with the TP regulations is a minimum of 3,500 current points. And currently one current point is shillings 15,000. So this translates to 52.5 million shillings or 23,000 USD. It is a lot of money. Next. In my conclusion, you will see that with the introduction of TP regulations, more formal, rigorous, and perhaps more frequent TP audits will be common. This actually is evident these days. It is something that is very common to have a client who has been subjected to transfer pricing audits. So all taxpayers need to ensure that they focus on their compliance and pricing mechanisms. Many taxpayers will now be required to attach TP documents with their tax returns. Actually, we say that this should not be taken as a compliance burden, but appropriate measures should be given to a number of TP aspects arising from the current regulations. And to do this effectively, the required documents should be prepared well in advance before the submission deadline. In case you are to submit with your annual returns, or in case you have to make them ready for submission when required by TRA within 30 days. But despite the possibility of harsh penalties, there is also positivity and more clarity in the regulations compared to the previous regulations. So we urge all our taxpayers that it is time to put in place appropriate transfer pricing documentation before their first return. Or in case they have not reached the threshold, make sure that once you reach the threshold, the documentations are ready to avoid any run-ins with TRA. That takes me to the end of my presentation. Thank you. Asanteni sana.
Thank you, Fidel. Fidel, thanks for walking us through that. Yusuf.
This is Yusuf.
Yusuf. I'm looking at the Rwanda presentation already. Yusuf, thank you so much for schooling us on that. And I think for me, from all the presentations that have been made, one thing is clear. The standards apply, the basics apply. How it's applied might change. Bits and pieces of how it's applied might change, but the standard still stands. So having seen that, it's time for us to go to Rwanda. But before that, I want to mention that if you've missed any part of this webinar, you can always listen to it once again on our YouTube channel. So tomorrow we will have this updated by 11. You can listen to all the webinars we've had as video for this year, which is about 8-10 webinars. Other than that, I want to now invite our presenter from Rwanda. And Fidel, I wish we could squeeze this in about 10 minutes so we can catch up on time. Fidel is a manager, tax in our Rwanda office. He's been in the practice for about 12 years. He's advised several clients on different matters, many of which are on transfer pricing. His last name requires you to have a certain DNA of an African to pronounce. So I'll just call him Fidel. Fidel, you're welcome.
Thank you. Thank you very much. And much has been talked about. I think I will go quickly and focus on what was not talked about by my colleagues. Otherwise, so many has been seen. So in Rwanda, in our income tax law for 2005, there was an article 30, that was obliging related parties to transact at arm's length. And that article was not clear to the extent that in 2007, a ministerial order was promulgated to govern the application of the income tax law, specifically on a method that can be used when determining the arm's length. And in that ministerial order, we had only 3 methods. This is comparable and controlled price, the sale price method, and cost price. In 2018, a new law, we call it a law, a new law or an act. We call it an act, we call it a law, they are the same. A new income tax law was enacted, and in Article 33, it was obliging related parties involved in a controlled transaction to have a document. Now the TP document is coming in. To have a document justifying that their prices are applied according to the arm's length principle. And that article says the ministerial order will give more details. This ministerial order came in late after 2 years in December 2020 with the details of how you can prepare your TP documentation. So go to the next slide. Yes, Article 2 of our guideline says the scope is, okay, who are required to, or who are taxpayers required to prepare the documentation? I will emphasize on a specific for Rwanda because in other jurisdiction, residents related, most of international jurisdiction, resident related persons are not required to prepare the document, but for Rwanda, it's not the case. Even resident related persons are required to have the documentation. You can go to the next slide. But on the previous slide, on that slide, Emily, Steve talked about beneficial tax regime. Next, previous slide, please. Yes, Steve talked about the beneficial tax regime, and in our TP regulations in Rwanda, what we call beneficial tax regime, it's a tax regime that does not tax income or tax it at a maximum rate of 20%. Again, a tax jurisdiction that grant tax breaks to non-resident individuals or companies is considered to be a beneficial tax regime. And again, the jurisdiction that does not require a taxpayer to carry out substantial economic activities within this country or tax jurisdiction. So there are some definitions of what we call beneficial tax regime. So yes, you can go to the next slide. Like many other TP regulations, transactions subject to adjustment of prices are these ones: sales, purchase, or transfer. In summary, any transactions that will affect the profit or loss of a taxpayer is subject to the adjustment. You can go to the next. Yeah, here we have conditions of taxpayers that are discharged or that are not required to prepare the transfer pricing document. This is Article 20 of our ministerial order. First of all, it says a taxpayer with the turnover below 600 million Rwandan francs. 600 million Rwandan francs is equivalent to 600,000 USD. Yeah, any taxpayer with the turnover below that is not required. However, you may be below the turnover, but again, required to prepare the document. If you have a related party transaction above 10 million or 10,000 USD, Rwandan francs, one transaction, in that case, you will be required. Many taxpayers were thinking about splitting that transaction to go below that, but it cannot apply because, again, if the aggregate value of related party transactions within a tax period is above 100,000 USD, you will be required to prepare the document. But again, any taxpayer who is not required to prepare the document must comply with arm's length principle. Next slide talks about method. Method of determining arm's length price. As Steve and Yusuf have talked about these. Yes, we have CUP, resale price method, cost price method, transaction net margin method, transactional profits split method, but we give taxpayers have a right to use an alternative method if the tax administration is satisfied that that method, apart from this one, you can use another method. The condition is that RRI will be satisfied that none of the approved method may be reasonably applied. These six. Such other method yield a result consistent with that which should be achieved by independent persons or transaction within arm's length. So you can, apart from common method, we know you can use another method under condition that RRA is satisfied with that. The next slide talks about how to come to arm's length range. And I have to mention that in some cases, statistical approach is used. If such approach is used, the interquartile range is considered to be arm's length principle. You know, this is when we involve the statistics is etc. So the next slide is on the source of information. Emerald, next slide. Yes, source of information. There is internal source or external source. This has been explained by my previous colleagues. So, but know that you have to know that in Rwanda, also Rwanda Revenue Authority will allow or will use internal source of information or external. Next slide is Article 17. Next slide. When to disregard the controlled transaction for tax purposes. So if the arrangement made in relation to a transaction between related persons differ from those arrangements between independent persons, the transaction as structured by the taxpayer may be disregarded for tax purposes. In such case, the arm's length position would be as if the transaction has not occurred. It will be disregarded 100%. So there are some specifics in our TP regulations. So go to the next slide, and then we talk about adjustment for domestic transactions. Domestic transaction may be adjusted if an adjustment is made by the tax administration to taxable income of a taxpayer in relation to domestic transaction. The tax administration makes inappropriate adjustment to the taxable income of the other party because the two parties are local. It would not be reasonable to adjust the transaction of one taxpayer and fail to adjust the other one. So domestic transactions, if you are to adjust one, you will adjust the counterpart. Okay, the next slide. Adjustment for international transactions. In some instances, international transaction may be adjusted. Here we have example. An adjustment is made or proposed by a tax administration of a foreign country. Let's say if Mauritius has requested Rwanda to adjust any transaction because in their country it was adjusted, Rwanda will do it. We have so many examples. You can go to the next slide. Next. Yes. Oh, you can come back to the previous, please. Previous. Yes. Next. Okay. Yes. Adjustment for services or consistency of services between related parties. Like my colleague in Tanzania said or explained, the fee is charged for a service that is actually granted. So RRI is emphasizing on the substance of the transaction, because some taxpayers may have transactions in their books, but when you do deep analysis to see if really the transaction occurred, you come to a different scenario. So they are insisting on the substance of or occurrence of the transaction. You can go to the next. Yeah, intangible property. For intangibles, you have to analyze the function performed by related parties, management of those functions. So for intangible also, there are a set of things you have to look, and these are well explained in Article 23 of our TP regulations. Can you go to the next? The next also is this special factors relevant to intangibles. As I said earlier, the expected benefit from intangible property must be ascertained. Yes. Can you go to the next? Failure to comply with our regulations. Here we are saying that we are new in TP regulations. Yeah, you see in 2020, we are not mature like other countries like Kenya, like Uganda, even Tanzania, because the regulations came in 2020, but failure to comply with them, there are penalties in our tax procedure. This law is a law describing all penalties that will apply to a taxpayer. So, Article 83 of our tax procedure law says taxpayer who will fail to comply with the TP regulations will be fined by 5% of the value of the controlled transactions. You see that in some cases the situation may be worse. So the reason why we have to tell our clients to comply with this. Otherwise, during the TP audit, that fine will be applied 5% of controlled transaction. Imagine if a transaction is 500 million, 5% of it is a huge amount. So our taxpayers have to comply as soon as possible. The next slide. A document required. This is Article 17. First of all, taxpayers are required to prepare the TP document and they keep it in their premises, not to submit it. They are not required to submit it to the tax administration unless the RRA requires to do so. So first of all, you have to prepare the TP document. Secondly, you have to prepare annex. I will show you how those annexes will be filled at the end of this presentation. But there is an annex that is filled. It is an Excel and it is submitted alongside CIT return in March. You have also to keep copies of intercompany agreements. Many taxpayers think that these agreements are the TP documentation. No, these are the copies of agreements in every transactions you will have internally, but these are not, these copies will not replace the TP document. Also, you are required to keep the country by country reporting if the ultimate parent is required to do so. Yes, you will describe your organization structure, and this is mostly included in the TP document, and any other document that can justify that you are transacting at arm's length, you can keep it. Next slide. Yes, it's the TP status in Rwanda. We are now a member of Global Forum, and RI started the TP audit because this is promulgated in the law of 2018. They are now they are conducting some, so taxpayer will not be surprised if they are notified that the TP audit is coming. But for APS, we have no provision yet. Next slide. Yeah, yes, what you are required to do, I explained this in the previous slide. You prepare the TP, etc. And you submit to the tax administration whenever required. Yes, next slide. This is the annexure you will have to fill and submit alongside the CIT return. It is a long file in Excel. This is from column A to column I. Next. This is column J to column P. It's very long. Next. Yes, it ends here. So you will have to fill this annex and attach it to your CIT return. Next slide, I think we are towards the end of the presentation. Yeah, we are done with Rwanda, and thank you very much.
Fidel, thank you so much for schooling us on the transfer pricing specifics of Rwanda. Our time is fast spent, and we are moving closer to the end of this webinar. But before that, allow me to introduce a gentleman from Ethiopia who's going to walk us through the specifics of Ethiopia. He's an equally very experienced professional with about 25 years. That might be older than some of the people we have on the call. But ladies and gentlemen, join me welcome Getinet, a tax director in our Ethiopia office. Getinet, you are welcome.
Thank you, Moses. I will be presenting a brief regulatory framework in Ethiopia. So you can go to the next slide, please. Yeah, this slide shows the summary of the legal provisions, starting from the proclamation that was issued in 2002 until the current ITP, which was issued in 2016. Now, the applicable directive, which is 43/2005, was issued pursuant to the ITP proclamation. So it was in force starting from 2015. However, the ITP 1286 was repealed and replaced by ITP 979 in 2016. So despite the cancellation of or the replacement of proclamation number 2086 by 979 2016, the directive which was issued pursuant to ITP 286 remains in force. So still this directive is the working regulatory document for transfer pricing in Ethiopia. So briefly, Article 79 of the ITP is related to transfer pricing, which includes the definition of arm's length transaction, adjustment of taxable income of transactions that are not arm's length. And in fact, it says the Ministry of Finance will issue a directive for the implementation of the transfer pricing, which is this directive number 43/2015. Article 3 and Article 4 of the Federal Income Tax Administration Proclamation. Now it defines what is a fair market value and what is a related persons. So we have two proclamations that are providing for the transfer pricing in Ethiopia. So next, please. So as previously explained by my colleagues, still the OECD guidelines are, pretty much applicable to the transfer pricing regulatory framework of Ethiopia. So, but in this case, if there is any difference or conflict between the OECD guidelines and the provisions of the local tax law, the local tax laws prevail, because this is one of, I think I heard that most of the presenters are in line with this application. Next, please. So we briefly summarize the contents of the directive. Go ahead, please. So the first one is the scope of application. Now, the application is any international transaction by related persons, any international transaction. So there is no any threshold set for the international transaction that is applicable for transfer pricing. Domestic transactions between related persons having annual turnover more than ETB 500,000. So this means that the current exchange rate is around 10,000 US dollar. Okay, so the other is the arm's length principle. So this principle applies, the same as the region. So I will skip this part. So this also comparability, it is also the same, as explained by my colleagues previously. So let's skip it. So these are also the transfer pricing methods. This has been also pretty much explained by the previous presenters, and we can skip. So the transfer pricing documentation, briefly, this documentation, is required that the taxpayer must have in place this documentation. Okay, whether it is filed or not, this requires the taxpayer must be prepared, for proving that the transactions with a related party are, at arm's length. So for that, here the taxpayer is required to prepare the documentation. So it also, the documentation provides the contents that must be included in the document. This is the language. It can be submitted in the local language, Amharic or English. Documentation is considered contemporaneous. Now, this is, you know, if it is in place at the statutory tax returns filing date, that is only when it is considered relevant. Otherwise, if it is not filed within the time or the period set by the law, it will not be considered as filed, okay? So prior filing is not required, by the way, according to the laws, but the documentation shall be submitted within 45 days of a written request by the tax authority. So there is no requirement, you know, to file the transfer price documentation, but it must be submitted within 45 days if requested by the tax authority. So here also the tax authority has the right to request additional information while conducting the audit. So if the taxpayer you know, claims that they have already submitted the transfer pricing documentation, they cannot say that additional information cannot be requested by the tax authority. So the tax authority has anytime the right to request the additional information. Next, please. So these source of information are pretty much the same as discussed previously, so we can skip. These are also the other provisions which are explained also pretty much by my colleagues previously, so we can skip it. So thank you very much. Maybe if I have to, you know, elaborate some questions later on, okay, I will come back, you know, for answering questions. Thank you very much. Thank you, Moses. Back to you.
All right. Thank you, Getting for keeping it that brief. We've come to the very end. We're going to use the next 5 minutes to go through South Sudan, and then we'll get to the Q&A. And then we'll have one more presenter and go to the Q&A. So join me in welcoming Juma Buli, who's been in the practice for quite a bit of time. He's been on both sides of the coin. He worked with the URA, and now he's on the other hand helping clients manage their taxes. So Juma will walk us through South Sudan. Juma, you are welcome.
Can you hear me?
Yes.
Okay. Thank you, Moses. I am going to run through South Sudan quite quickly. As you may know, South Sudan is the youngest state in the world. So you don't expect it to have, you know, very developed transfer pricing rules. So the scope, what is the scope of transfer pricing in South Sudan? It mainly covers cross-border transactions. As you've heard from other presenters, some countries have rules whereby transactions between related parties domiciled within the state are also in the scope of transfer pricing, like in the case of Uganda. For South Sudan, only cross-border transactions fall into the scope of transfer pricing. Next slide. Now, the transfer pricing rules are contained in Section 81 of the Taxation Act of South Sudan, and it doesn't really deviate from the general rules that are followed, by all the other countries. As you may know, transfer pricing is an international tax matter, and therefore the rules are similar in most of the jurisdictions. Next slide. So, like in other jurisdictions, South Sudan attempts to define who elected person is, and the reason why this definition is important, because that is when we determine which transactions actually fall into the scope of transfer pricing. So I'll not go into this because my colleagues have talked about it. So just go to the next slide. So when you look at the transfer pricing rules, which are contained in Section 81, they talk about the methods which are permissible for determining the arm's length price. And in the rules, we have those three methods: the comparable uncontrolled price, popularly known as the cap, then the resale price method, then the profit margin method. Now, this is sort of a departure from what my colleagues have talked about. The rules in South Sudan only talk about these three methods. This is, we were to see this actually in practice, because from transfer pricing, as you may have heard from my colleagues, the transactional net margin method, or the TNMM, is the most used method in transfer pricing. So like more than other people put it at 80%, others at 90%, this is the method that is used. So the unique thing about South Sudan is that that method is not permissible. It is only restricted to these traditional methods. So I think in practice, we may have, we may see this change, because as you may know, sometimes what is in the law is not what is in practice, is not what is practiced. Because as I said, the TNNM is the most common method used. And if you restrict yourself to these three methods, then you might find yourself in a situation where you are not able to determine the arm's length price. Next. So these are the methods. I will not go into detail how they work, because there's no deviation from the international practice in the way how these methods work. So I'll just go to the next slide. The resale price method, still no deviation from the way it works based on international practices. So the documentation, what type of documentation is required? Now, the difference here is that unlike the general guidelines under OECD, whereby you are required to have a single document detailing all the related party transactions and how the arm's length price has been determined. In South Sudan, you are required to have a separate documentation for each transaction. And this is quite rare, but that is what the law says. And how it is practiced is another thing, because as I've said before, the transfer pricing rules are quite young, so we've not seen some of these things challenged by the courts or by the taxpayers. So that is the unique thing regarding documentation requirements for South Sudan. So in a nutshell, for South Sudan, the scope does not cover domestic transactions, only cross-border transactions are covered. And OECD guidelines are generally followed. South Sudan is not a member of the OECD, but generally the the guidelines which are documented by the OECD are followed. Then the, the number of methods, I mentioned them, they are just 3. The number of methods which are permissible, that is the cap, the sale price method, and the cost plus. You've had my colleagues talk about the country by country reporting, which is under the BEPS Action Point 13. These are not required in South Sudan. Of course, you wouldn't expect them to be required, considering the fact that South Sudan is relatively new state with relatively new, the transfer pricing guidelines are quite new. Then regarding the penalties, there is no requirement to file transfer pricing documentation with the Revenue Authority in South Sudan. So that means that there will be no attendant penalties in that regard. And regarding the advanced transfer pricing agreements, or the APAs, we don't have any regulations in South Sudan regarding APAs. So in a nutshell, that is what South Sudan transfer pricing regulations look like. And as you have noted, the only thing that is different is that there is a requirement to have separate documentation for each transaction, and then the restriction of the methods which are permissible to the 3 which I talked about. So how can we support you as BDO? As you've seen, many of my colleagues have talked about the transfer pricing regulations in the respective countries. So how can we support? So we can support you in preparation of transfer pricing documentation. As we've seen, all these countries that we've talked about have transfer pricing requirements. So that is where we come in, to come and support you and draft and write these documents for you. The other way of helping you comply with transfer pricing requirements is we can help you review the existing transfer pricing documents. As you may be aware, generally, a transfer pricing document has to be updated every 3 years. That is according to the OECD guidelines. So we come in and help you review these existing transfer pricing documents and help you update them. The other issue is I think you've heard from Kenya and Uganda. There is a lot of focus in regard to transfer pricing reviews. Revenue authorities have taken a lot of interest in transfer pricing because they want to know, they want to get their fair share of tax. And they also know that there is a lot of aggressive tax planning around transfer pricing. So they are really very aggressive in this area. The other thing I wanted to add regarding aggressiveness of revenue authorities, some people think that maybe the revenue authorities do not have capacity to handle some of these audits. Yes, we may have some of those capacity issues here and there, but there is an initiative by the OECD whereby they help revenue authorities during, for instance, transfer pricing audits. I don't know if you've heard of Tax Inspectors Without Borders. This is an initiative by the OECD whereby they use this arm to help revenue authorities beef up their own capacity in regard to transfer pricing and international tax generally. So there are times when you're actually interviewed during a transfer pricing audit by a revenue authority at the same time with someone from OECD under the Tax Inspectors Without Borders. So when you see this happen, that shows you the aggressiveness that revenue authorities are doing in regard to transfer pricing audits and in regard to beefing up their own capacity around transfer pricing and international tax. So briefly, that is how we can support you. And thank you very much for listening to us. I'll hand back to the moderator, Moses. Thank you very much.
Thank you, Juma. Just get rid of the echo. Thank you, Juma. And I'm glad you ended with the slide on how we can support after all that has been said. Now, a lot has been said, a lot has been learned. And from what we see, the tax authorities in different countries are becoming very aggressive. So it's only important for you to equip yourself with this kind of knowledge. And again, we don't expect you to master all this in one day. It's a piece by piece. Maybe you'll pick one or two things from this. If you have a challenge digesting any other parts, we are always available to support you on that. Now, our time is fast spent, but I want to invite the Director Tax in Uganda to sort of tie the pieces together out of all that has been said from the different countries. So, John Jett, you are most welcome to share with us.
Thank you very much, Moses. Can you hear me?
Yes. You
can see me?
Yes.
Excellent. I want to thank the presenters, my colleagues from the region, for making time. But most importantly, I want to thank the participants. Each one of you who is on this call, I want to personally thank you for making time and staying around even when we've exceeded the time we had promised. And as you can see, this transfer pricing is a very wide subject matter that cuts across countries. And from the presentations, you could see that there's commonality around the principles that are being applied in each country within East Africa. But at the same time, there are certain unique elements that apply to the respective countries in the region. And also the levels of compliance standards are different. There are basic compliance thresholds, they are the same, but when it comes to penalties, when it comes to the level of detail required, we see some differences. What that means is that if you're doing business in East Africa, you should be comfortable knowing that you have BDO on board to support you across the region to meet the compliance requirements from a transfer pricing perspective, but also to ensure that you're facilitated to meet the local standards on ground. Like Juma mentioned that the law in South Sudan might say one thing, but the practice is different. So meaning that you need someone who appreciates the implementation of transfer pricing rules on ground. And as BDO, we are available to support you in ensuring that your transfer pricing documents are in place, ensure that in case of a review or request for information from the tax authority, we guide you along the way. We support you to ensure that first of all, you comply to avoid the penalties, but at the same time, you minimize the impact of potential tax adjustments. And going forward, as you can see, the experts from all the countries in the region, we are there to support you. Please do not hesitate to reach out to us, send us an email, give us a call, and we'll be able to support you. And as you see, at the end of this session, you realize that transfer pricing is a bit complex compared to other tax matters. And that's why we have people within BDO who are specifically focusing on transfer pricing. So we encourage you not to start preparing internal transfer pricing documents by yourselves, because what we have seen, you prepare something thinking that it is in compliance, but when you look at it, or when the tax authority looks at it, there are a number of gaps, and it is late by the time the tax authority requests that you need to make those changes. So I encourage you that you involve us in your business, in your planning, when you're transacting, when you're entering into contracts with related parties, such that from a tax planning perspective, you're covered and the risks are managed. And maybe the other aspect which we need to emphasize is, on one hand, there's transfer pricing aspect, but then some of these transactions you have other tax implications. For example, withholding tax or VAT on imported services. Those are aspects that the tax authorities first look at before analyzing whether your transaction is at arm's length. So those are areas that we look at when you come to us, when you engage us to support you. I would like to finally thank you very much for attending this webinar, and we look forward to the next webinar, which I think will be November, where now we'll be going into more aspects of, if you're being audited from a transfer pricing perspective, what to look out for, what should you do to make sure that you manage transfer pricing risks. And as you can see, where we are going, transfer pricing is going to be a major source of revenue for the East African governments. And that means that audits are going to be more. And we need to start preparing so that we are not caught off guard. Thank you very much.
All right, thank you so much, Jet. And I like the way you tied it by saying it's beyond transfer pricing. Beyond transfer pricing, there are other aspects that we can support you on. And again, beyond transfer pricing, there are other tax aspects that you need to think about. So having said that, I think for me, it's been very interesting. It's been good that from the onset, we've had an all-inclusive conversation, at least for the East African countries. Many of them have been covered. And at least all that we need to know for the start has been covered. And I'm sure that in the next part, we will then go deeper, which is going to allow our audience appreciate these concepts better. So I'd like to appreciate all the panelists for coming today and speaking to us. We've had a few questions coming in, but we will surely have to answer those via email. We can't have all of them answered here in the interest of time. For those of you who have questions and you have not sent them, I'll just put an email in the chat section. Video communications, you can send all your questions to that and we will have them responded to. At the end of this, we're going to issue certificates. They should be coming probably tomorrow to all participants. They will come through your emails. So hopefully you have registered using your right names and the email that you expect to receive the other communication on. I also must say, if you've missed any part of this webinar, they will still be available starting tomorrow at 11. It will be on our YouTube channel, which is Video East Africa. Just look for Video East Africa. You will find the recording uploaded there. The slides will equally be shared. Other than that, it's been a pleasure having all of you here. It went to about 500 participants, highest, and we are glad to have hosted you all through this event. Other than that, I'd like to wish you a good night for those of you in East Africa. For those of you in other parts of the world, I'd like to wish you the very best in the remaining part of the day. Thank you, everyone. And this brings us to the very end of the webinar. Thanks. Bye.